On that note, I'm going to hand over to Zahir Ante. Zahir is the chair of the Employee Benefits Executive Committee for the FIA, as well as being an expert in employee benefits and having a full-time job he has to be responsible for and a family that he takes care of. And yeah, so we welcome you and we thank you for all the hard work that you put into these events and to the employee benefits space for our intermediaries on this call. So welcome, Zahir, and I'm going to hand over to you.
Thank you so much, Sandra. Thank you so much. And thank you and the FIA Secretariat for arranging the webinar so efficiently and so effectively, Sandra. It's always appreciated. So I think there are still some people joining, but I think just in the interest of time, I think let's begin. And I see we have our first speaker present as well. So this is a good time to start. Good morning, everybody, and welcome to the FIA 2024 Employee Benefits webinar. So today, it's no surprise that we're discussing a fundamental restructuring of the South African retirement system. Not to be dramatic, but we're not just talking retirement. Today, we're talking evolution, or more specifically, the revolutionizing of the retirement landscape and our entire approach to retirement savings. Over the next 90 minutes, our expert speakers will delve into the nuances of the two-part system, exploring its implications, its challenges, and of course, its opportunities. I want each of you to imagine this webinar as a traditional South African three-leg potjie pot, where each leg represents a crucial perspective. So our first leg is National Treasury, represented today by Tandazile Alvina Thiele, who is the Chief Director of Financial Sector Development at Treasury, and she will guide us through the latest two-part retirement reform updates, as well as discuss potential future enhancements to the South African retirement system. The next leg of the potjie pot is corporate, represented by Prabashini Moodley, who is the Managing Director of Old Mutual Corporate. Prabashini will offer us her unique corporate perspective, sharing some valuable customer insights, and of course, highlighting the role of the intermediary. The third leg is you, our audience, advisors, consultants, intermediaries, and representatives of this industry. The objective of our panel discussion today is to provide you with a platform to engage with key industry stakeholders and thought leaders in both government and corporate. For the panel discussion, Tandazile and Prabashini will be joined by Johan Prinsloo, who is the Head of Retirement Fund Administration at Sanlam, as well as Dwayne Naiker, who is the Head of Retirement Solutions at Alex Forbes. I encourage all of you to ask the difficult questions and to share your concerns openly. This is a safe space, I promise you that. And the only silly question is the one that you don't ask. So the Q&A box is available for all of you to post your questions. But I also encourage those of you that are brave enough to do so, or those of you that are open to it, to allow us to turn on your camera and mic so that you can engage directly with our panelists. Now, in reality, I'm well aware that there are many more legs holding up this particular part, or these two parts or three parts, but we only have 90 minutes, and that doesn't quite work for my potjie metaphor. So for today, three legs it is. I'd like to introduce our first leg or speaker, who is Tandazile Alvina Thiele. At National Treasury, Alvina's role is to design and develop policy and review the legal framework for the promotion of appropriate market conduct, transformation, consumer education, and inclusion with respect to banking, insurance, investment, and of course, retirement funds. Tandazile also represents Treasury at NEDLAC and the Financial Sector Transformation Council, on forums for pension fund related matters. And so without any further ado, I hand over to our first speaker. Welcome, Tandazile.
Thank you, Zahir. And yeah, this course needs a slow cooker. It's been cooking for a while and it's still not yet ready. Still adding more ingredients and making sure that it is perfected. Thank you to FIA for arranging this. I think this should be many more to come because we really need to communicate and communicate properly to dispel whatever misunderstanding is out there. So I have no doubt that the participants have seen and have heard the slides that I'll be going through. Please let me know if you are able to see the slides.
Yes, Tantazile, the slides
Okay.
are on the screen.
Okay, awesome. I'll quickly run through them because I think, as Zahir mentioned, we only have 90 minutes. That's not a lot of time, and it would be great to actually hear from the participants questions that they have and any pointers that we need to be looking at. So I'll be taking you through, the slides look long, but I'll just quickly go through them. I'll take you through the policy background, the reforms themselves, other laws that we are amending to complement the two-pot regime, the regulatory oversight, and any facts to note, and further enhancements that we'll be introducing later. And then lastly, just to cement this off, examples to ensure that we are all on the same page. So on the background, I think we should all be aware that the retirement reform process dates way back. I think it's even before 2012. But when I started Treasury, it was resuscitated in 2012. It's a long-term process. It needs buy-in from members, from labor, from industry, the regulators. So there's quite a number of parties involved in the retirement industry. So everyone needs to be fully on board and understanding of the changes that are being introduced to ensure that the process and the change is smooth. So when we started with the retirement reform process in 2012, we released a number of papers. These papers are available on the Treasury website, and they dealt largely with encouraging preservation, enhancing the governance of retirement funds, encouraging annuitization. This was for Provident Fund members. It had come into effect already, March 2021. We simplified the taxation of retirement fund contributions. As members are aware, prior to 2021, 2016, Provident Fund, retirement annuity funds, and pension funds had a different tax treatment when it comes to retirement contributions. So that has been harmonized into the 27.5 up to 350,000 per annum. We've tried to encourage non-retirement savings through the tax-free savings accounts. And lastly, this is the most sticky one, ensuring that members get value for money when it comes to their retirement savings, despite the retirement product that they're saving in. So with the two-pot retirement policy system, this was largely nudged or encouraged by the COVID pandemic that we went through. Firstly, the concern, sorry, Zahir, I think that someone is not able to see the slides. Are you able to see them? Are they?
I can see it on my
You
side,
can.
Tantazile. Is there
Okay.
anybody else who's struggling?
You find Sandy on your side? Great. I think maybe the colleague might need to log off and rejoin. Tabello, please try leaving and then rejoining the meeting. So on the background, when it comes to the two-part retirement system, the first concern is preservation. We all know that when employees resign, they tend to cash out and take everything. And the challenge was that they get to retirement, they only have to rely on the old age grant, or if they were able to get another job, whatever they have saved, it's not sufficient enough to sustain them. So that has been the first challenge. The second challenge is that during COVID, we had employees that had savings in retirement funds. And some of them, their salaries were cut, some of them, their salaries were paused. They had nothing else to live on. Meanwhile, they had a pot of retirement savings sitting, waiting for retirement and or resignation. So two-pot system then says, let us encourage access, limited access, sort of restructure the retirement system to allow members a portion of their retirement savings in cases of emergency. This is not prescribed in law, but it's advised that you only access your retirement savings when there is a dire need to do so. And then have another chunk or another portion saved for retirement purposes. So to address these two concerns, we made announcements through the budget and the medium-term policy statement. We also issued a discussion document inviting public comments in December 2021. Following that, then we had the law, the Revenue Laws Amendment Bill, that was also released for public comment. So the changes that we are proposing to the retirement sector is that we have these pots. Zahir calls them legs. They're quite different variations. We call it two pots, but it's actually three pots. So the two new pots that I created is the retirement pot. So with the retirement pot, two-thirds, a total of two-thirds of a member's contribution goes into this pot, and this is preserved until retirement. The one-third of the members' total contributions goes into the savings pot. This is accessible without the member having to resign from their job. And this pot will not start from scratch. It will be started off with 10% or 30,000, whichever is lesser, transferred from this pot. If you have a member that is already contributing to a fund by 1 March 2024, this member will have accumulated something. Whatever has been accumulated is what we call a vested pot. So 10% up to 30,000 of this pot will be transferred into the savings pot to start it off. Then this pot gets ring fenced. It will grow, it won't be stagnant, but no further contributions will go into this pot. There is just one slight proviso. I'll get to that now, which is Provident Fund members who were over the age of 55 as at 1 March 2021. So these members, only these members, Provident Fund members over 55, will have the option of whether to become part of the two-pot system or not. So if this member who was 55 and older on 1 March 2021 decides to be part of the two-pot system, then this gets ring-fenced and then they contribute 1/3 into the savings, 2/3 into the retirement pot. We call pots, we call components. The law now refers to components, so please do not be confused when I use the word pots and components interchangeably. They basically mean the same thing. Now, the two-pot system will apply to all funds, private sector funds, public sector funds, including defined benefit funds. The slight variation is that unlike defined contribution funds, defined benefit funds use a formula but they will still have to apply or comply with the two-pot system regime by splitting the members' pensionable years of service. Say, for example, a member has worked for 9 years, so the defined benefit fund will still need to create a savings and a retirement component. Using that example of a member that has worked for 9 years, it would mean 1/3 of the 9 years, 3 years, will be used as a savings withdrawal whenever a member decides to withdraw, with the 6 years being kept preserved in the retirement pot. And also, there is a vested component where defined benefit will have to calculate 10% of that defined benefits member on 31 August, 10% up to 30,000, and transfer that into the savings component. So I've mentioned that Provident Fund members over the age of 55 as at 1 March 2021 have the option to be part of the two-pot system. This is because those members, remember, March 2021, we introduced the annuitization requirement for Provident Fund members, and those members were not part or have been excluded from that annuitization requirement. So we are allowing them to proceed or to continue with that vested right unless if they choose to be part of the two-pot system. There are other funds that are excluded or that might be excluded from the two-pot system. These are old generation retirement annuity funds. So these have largely an underlying insurance product. Having to wind down this insurance product might be costly and might be at the detriment of the member. So these funds will have to apply for an exemption from the FIA. So it's not all generation funds that might be excluded. Other industry participants said they will be okay with complying with the two-pot system. Others said they would prefer to apply for the exemption. We will also be excluding, without any exemption, a pensioner. Remember, a pensioner is already receiving a pension or an annuity, so there are no contributions that need to be split in terms of 1/3, 2/3. Funds that are in liquidation, there is no need for them to apply the two-pot system. Closed funds, as well as beneficiary funds. These are the funds that hold death benefits for minors. So we've amended the Income Tax Act through the Revenue Laws Amendment Bill to introduce the two-pot system. We've also had to amend the Pension Funds Act because that's the primary legislation for retirement funds. But the amendments in the Pension Funds Act are mostly for deductions. So we've introduced the definitions that are in the Revenue Laws Amendment Act. For example, your savings component, retirement component, vested component. We have referenced those in the Pension Funds Act. But the gist of the amendments in the Pension Funds Act relate to housing, divorce, maintenance, and liabilities by members, how those should be allocated. So those should be allocated across all three components that a member has: savings, vested, and retirement component. So coming to withdrawals, remember a member has 3 pots: the savings, retirement, and the vested component. Starting with the savings component, a member can make withdrawals from this pot without having to resign. And only one withdrawal per tax year is allowed. And that withdrawal should not be less than 2,000. We do not want to turn retirement funds into bank accounts where a member comes for 500 Rand and then comes 2 months later for another 200 Rand. So the withdrawals, it's whatever is in that pot can be withdrawn, but it should not be less than 2,000 Rand, and it's only once a tax year. It is unfortunately taxable in terms of the member's marginal tax rate. So if a member has multiple contracts, you are a member of an occupational fund. You also, as a member, have a retirement annuity fund or a preservation fund. You are allowed to withdraw from any of those funds. You are not restricted to one. So withdrawals are per contract, not per member. Say, for example, a member has made a withdrawal within a tax year and they resign, and whatever is left in that fund is less than 2,000 Rand, they are able to take the remaining balance. Moving on to the retirement pot or retirement component, this is preserved until retirement, so it cannot be cashed out. It's subject to preservation, so what we call preservation, so no withdrawals can be made from the retirement pot. And when a member gets to retirement, they would have to receive this as an annuity or a pension. When a member resigns, they are able or they are allowed to transfer from the pot. Remember, you are in a fund and your fund value has 3 pots. So it's still your account that sort of has 3 pots or 3 components. At the resignation, those pots that you have move as they are to the prospective fund that you are moving into. Within the same fund, a member is not resigning. Within the same fund, a member can move funds from the savings component to the retirement component, from the vested component to the retirement component. But because this retirement component is subject to preservation, it's locked in until retirement, funds can move the other way. You can move money from a retirement pot to a savings or a vested pot. So I've mentioned this. At resignation, when a member terminates membership, they can transfer. The pots move as they are to the next fund that the member is transferring into. When a member resigns, they can transfer to another fund. This vested pot, because it's in terms of the current rules, it can be withdrawn subject to the current tax treatment, which is a early withdrawal tax table, or it can be transferred. The savings pot is accessible subject to tax once a year, not less than 2,000 Rand. The retirement pot is preserved until retirement. So this is a resignation scenario for pension and provident funds. This one, the vested pot, it's what a member has accumulated before the 2-pot system comes into effect. It can be withdrawn or transferred. If it's transferred, everything goes together to the next. You can't transfer this pot to a preservation fund. You can transfer this pot to another fund. You can't split them when you transfer. They all go together. However, this is still accessible. This pot, retirement pot, is not accessible until retirement when a member resigns. Moving on to a scenario where a member is retrenched. The vested pot is treated again in terms of the current rules. Currently, if a member is retrenched, they get a retrenchment package. So this will still apply. Member will be able to get this vested pot as a retrenchment package. The retirement tax table is applied. The savings pot, annual withdrawals subject to tax not less than 2,000 Rand are allowed going on. The retirement pot again, dealing with the retrenchment scenario, the retirement pot is preserved until retirement. We get to a retirement scenario. My time is up. I'm almost done. We get to retirement. The vested pot is treated in terms of the current rules. When you retire, when a member retires currently, 1/3 is cashed out. 2/3 is subject to annuitization if it exceeds the de minimis threshold, which is 165, except for members that are 55 years and older on 1 March 2021, they are not subject to annuitization. The retirement scenario for a savings pot, this is accessible as a cash lump sum in terms of the retirement tax lump sum table. And the retirement pot needs to be annuitized. Remember, this pot has been preserved all the years that the member has been working. It needs to be annuitized subject to the de minimis. So there are other funds that fall outside the Pension Funds Act that also have something similar to 37D deductions that we have in the Pension Funds Act. So these are your government employees, Post and Telecoms members, and Transnet Pension Fund members. They are also part of this. Remember, I said the two-part system applies to all funds. So we've had to amend these laws as well to allow for deductions. Deductions, that is divorce orders, maintenance orders, when a member owes the employer, these deductions or orders can be allocated or taken from all the 3 pots that a member has. So savings, retirement, and the vested components needs to be allocated proportionally for all the 3 orders, court orders that need to be deducted from a member's benefit. So we have regular meetings with Revenue Services and FSCA towards implementation to make sure that everything is in order. We also meet with industry to ensure that the legislation covers everything that needs to be covered. FSCA also has regular meetings with the industry to monitor progress to ensure that they're able to provide or to submit their rule amendments speedily. What else? In terms of measuring or monitoring the impact of the two-pot system, together with the Reserve Bank, the FSCA, and Treasury, we will be monitoring in particular the impact of the seeding capital and ongoing withdrawals, comparing that to the current withdrawals that the members are making when they resign and cash out everything. We'll also consult with industry to ensure that the data that we collect with the authorities corroborates with what the industry sees as practice. We'll also monitor complaints through the pension funds adjudicator in terms of the applicability or the practicality of the two-pot system. What I think should be noted by the advisors or intermediaries is that there is a critical need for member education and managing member expectations. Members are expecting to withdraw quite a lot. However, they should be made aware that the seeding depends on the member's current savings. 10% up to 30,000. So remember, 30,000 is the ceiling. If a member has saved less than 30,000, obviously they won't get 30,000. Members should also be made aware that payments or claims will not be made speedily because the fund still has to undergo due process to verify the payments and ensure that there isn't any fraud, the claims or the withdrawals is paid to the correct individual or member. It's envisaged that when the two-pot system comes into effect, there might be a rush for withdrawals and there will be large short-term cash flows. However, over time, and also given that the two-thirds will be locked in until a member retires, there might be increased retirement savings. So the system tries to balance between the members' short-term financial needs and also long-term retirement security. Another things to note, it's the enhancements that we'll be making. This is for retrenchment. Currently, a member will only have access to a retrenchment package from the vested component. We are looking at once the two-pot system is done and it's properly working, we'll look at allowing some access to the retirement component for members that are retrenched, that are not able to find further employment, and that have also, if they are members or if they were contributing to the UIF, they have depleted their UIF benefits. Just as an example, once off seeding, it's 10% up to 30,000. Say, for example, Temba has 1.2 million. So if you calculate 10% up to that, it exceeds the 30,000. So it means Temba will get only 30,000. Another example, Tembi has a fund value of 200,000. You calculate 10% of her seeding, it's 20,000. It means Tembi will get 20,000 transferred from the vested component into the savings component. An example of the payments or contributions split into 1/3, 2/3. You have Amanda that contributes 6,000 per month into her fund. It means 1/3 of this 6,000, which is 2,000, will go into the savings pot. The 2/3 of the 6,000 will go into the retirement component, that is 4,000 monthly, locked in until retirement. We have a Q&A available on the Treasury website. FSCA has also issued communication, and I'm informed that SARS will also be issuing communication to members. Thank you, Zahir, and apologies for going over time. Yes, I have tried to share the slides with you so you can share with the members. I'm not sure if you have been able to receive them because they are quite large. I've also tried to share a link instead if you're not able to get the slides. But if you haven't received them, I will try to work it out between Tulani and our IT team in terms of how we get the slides so we can share with the members. Thank you very much.
Thank you so much, Tandazile. And in fact, there are some requests for the presentation. So I think we will do a communication post-webinar with just links to some of the resources and addressing some of the questions that we won't get to answer during the course of this webinar. And I see there are lots of questions, Tandazile. So I see you've definitely sparked some interest here. But I really look forward to addressing these questions in the panel discussion. I think that's where a lot of the real discussion takes place. And so immediately we'll move on to our next leg. And our next leg is Prabhashini Moodley, the MD of Old Mutual Corporate. Prabhashini is an experienced financial services executive and a qualified actuary. So she has over 20 years of experience across Old Mutual Limited, spanning various markets and functions. Prabhashini has been a managing director of Old Mutual Corporate since November 2019, and she's the group executive committee sponsor of the actuarial professionals within Old Mutual and is also a non-executive director across a number of boards. So clearly somebody who likes to keep busy. Welcome, Prabashini, and thank you so much for joining us. I'll hand over to you now.
Thanks so much, Zahir, and thank you to you and the FIA for the invitation. It's a pleasure to engage with you and all the members today. And fortunately, Tandile covered quite a lot of the details, so I'll be able to skip over those aspects that we've covered already. So I've called this presentation Two Pots, One Goal. And maybe just a little bit about that, the one goal ultimately, and I think that's the purpose behind, the work that your members do as well, is the financial outcomes for individuals or customers. And, Tandizile covered it. The intention at the end of the day for the entire retirement fund reform and two pots is to take into account the reality of what South Africans go through and that need to balance shorter term emergency financial needs with longer term retirement outcomes. So I will go, I hope the tech, I've also been having interesting moments with the tech. Okay, it is finally moving. Very little. I mean, I am from our employee benefits business. So this is the context that the employee benefits industry has experienced. Way back in the 50s, South Africa had mainly defined benefit funds that was in the private sector and the public sector. And in the defined benefit environment, your sponsor of the fund or the employer really took on the risk of members of the funds having enough when they're in retirement. So that's the risk of the amount that's saved, but also the risk of investment risk. But over time, there's been a massive shift from defined benefit to defined contribution funds. And right now in South Africa, with the exception of, the government employees pension fund and some of your larger municipal and public sector funds, most funds are defined contribution. And that means that the need for individual financial advice and guidance has just increased dramatically because now your individuals, your customers are sitting with the risk, the investment risk, as well as, the risk of not having saved enough for long enough for it to have accumulated for a decent income post retirement. So you see the shift. From 1983 we had 62% of employers in defined benefit. And now by 2016 already, 72% of employers in South Africa were offering defined contribution funds. And then you've also had a shift towards umbrella funds. I mean, as Old Mutual, we sponsor an umbrella fund as well. And this was really as as the regulation increased, as benefits of economies of scale come through, we actually saw quite a big consolidation in our occupational retirement fund environment, going from about 16,000 funds to 2020, they were just under 1,500 funds. And now with two pot, that is probably the biggest change in our industry in the last 20 years. It's actually good news for financial advisors and intermediaries, in my view, because it makes the value of what we do even more relevant and apparent for members. One of the parts which we talk a lot about employers and occupational funds, but this change also applies to retirement annuities. So, people are self-employed, then they're going to they make their own individual purchase of a solution to save towards their retirement. There's still employers in South Africa, quite a few, and maybe mid-sized companies, smaller companies that don't offer an occupational fund. And I'm sure many of you on the call have clients who have retirement annuity savings policies in their own name. And normally, or currently, let me not say normally, currently, the earliest that they can access those funds is at age 55 by purchasing an annuity or taking 1/3 in cash. And then on the institutional side, as already been mentioned, in South Africa, people do access, they can and they do access on resignation, retrenchment, or then on retirement. But post 1 September, both of these funds, so if you have a client who has both an individual retirement fund and belongs to an occupational fund, the new two-pot rules will apply to both of these types of policies. And I think Tandezile's covered this in a lot of detail, so I'll skip through that. And then she's also mentioned, yes, it's actually 3 pots, even though we are referring to it as 2 pots. And that vested pot just means all funds up to the implementation date are treated as vested, and then the current rules apply. So the new rules apply to all contributions from the 1st of September, and then there's the seeding amount as well. So maybe on the savings pot, I'll just touch on a couple of things that stand out for us and things that I think are really important to constantly emphasize and make your clients aware of. So, currently there is a 1/3 cash lump sum that can be taken at retirement. So this 1/3 that's going into the savings pot and being made available earlier is that same lump sum from retirement age, but it's being brought forward and is now accessible every year. What this does mean then is if your customer or client has taken out savings during the run up to retirement age, then what's available at retirement to be taken as a lump sum reduces by the savings amount, or the savings amount that was withdrawn, or whatever remains there. And then, of course, there's tax, and it's at the individual's marginal tax rate. So I'll also say, as industry, one of the bits about this implementation that makes us the most nervous is the volume of transactions, but also the volume of individuals for whom we're going to need tax directives, and just how we're going to deal between ourselves and SARS, multiple players in the industry and SARS, in getting that turnaround happening smoothly. And then access is once per tax year. I think this is also important for you to emphasize to your clients that, if you don't need the money, then don't withdraw on 1 September, because it will still be available for the remainder of the tax year and in every tax year. Another point that I think, and this is also, something hotly debated, certainly internally at Old Mutual, and I'm sure at various providers in the industry, there will be costs associated with withdrawing. And what isn't clear yet, or various providers will have to publish as we get closer to 1 September, is the legislation allows a withdrawal fee to be charged. Now, something we're debating is what is the right level of that fee. So there is a cost to administrators of putting in place all of the technology, the processes to be able to process these withdrawals. But how much of that cost do you pass on to savers? Also, given that we don't want to erode the value of their savings, and we still want to give value for money, but there is a very real cost of implementation. And then secondly, do you spread that over all the participants, even those who never use the withdrawal? Because the facility is available to everyone. So those are some of the debates that are happening internally, and the choices that product providers have to make. And then we've mentioned that in year 1, it's a minimum of 2,000, a maximum of 30,000. But after year 1, it's whatever the balance is in the savings pot. So if someone's 1/3 contributions accumulates to a lot more than 30,000, then that is what will be available to them in the savings pot in the future. Sorry, just trying to get this to move again. Okay, I thought it might be useful to share some of the insights we got from surveying our members. So we sent out a survey at the end of last year and to about 100,000 of our members, and we got about 12,000 responses, which I think is fairly significant. And I thought, sharing the insights, it also validates some of what we've already heard and highlights the role that you can play and where members or customers, in my world, we refer to them as members because we're in the employee benefit space. What are they looking for? So we tried to test for two things. One was the level of awareness and understanding of the whole two-pot system, and then the choice or decision around withdrawal or preservation and the implications. So the demographics of, and like I mentioned, just under 12,000 responded, and they're fairly representative. So they were largely in, Gauteng, KZN, Western Cape, and then 21% of those respondents were in other parts of the country. From a gender split perspective, you can see what it is, and they're across different life stages and across different income bands. So we think quite a representative number of people who responded. And then it was interesting, quite a few had heard about Tupot, but by the end of last year, not many had heard about it from their financial advisor. So only 4% saying they heard about it from their financial advisor, but that's irrelevant. What is more important and insightful, I think, is the fact that 44% of these people who responded have a very poor understanding of what it means. And then another 28% had some understanding. So there is quite a big job to do in terms of helping people be aware, but then understand what does that mean and what does it mean for them as an individual specifically. It's a lot of information. So I think our ability as an industry to really simplify and give people the information that's very relevant for their circumstances, I think that would be highly valued and be useful for people. Then we also asked people, are you going to withdraw or are you going to preserve? So on the left, we can see most people said they will decide when the time comes. So actually, there's a huge job in helping people to decide so that they make the right decision for themselves. There were 27% who were very clear they will preserve, and then another 27% who had already decided they will withdraw. And then in terms of the date, so when will you withdraw? When we did this at the end of last year, and some of you will remember, the initial date was March 2024. And there were people by the end of last year who were clear, they have a need for this money. They will withdraw as soon as it becomes available. And then, an even bigger portion, 75%, who didn't know yet and said only when they need it. Then we also, this is just telling you from a life stage perspective and an income band perspective. And it's interesting that it's even in your older or people in a more mature life stage, retirement facing, we classify as people who are maybe 5 years out from normal retirement age. Still 17% of them wanted to withdraw, but the most people who are saying they would withdraw are what we call family providers. So those are people with a high level of dependence and possibly children who still need quite a bit of care. On the right-hand side, by income band, and this is not entirely surprising, the highest proportion who want to withdraw are in the lower income bands. But interestingly, even at the higher income band, 23% at that stage said they want to withdraw money. And I mean, you will know a lot better than you being the financial intermediaries, that people face financial strain, regardless of their income band. This one I'm quite skeptical of, where we ask people what will they spend their money on, because I think you can ask people, but the reality is I suspect many people, will withdraw and use it for everyday consumption. That's my own theory. But to the point Thandazile made about people's expectations of how much is going to be available, to say you're going to improve your home or pay off your bond, when in reality, in year one, the maximum available for withdrawal will be 30,000 less marginal tax, less any withdrawal fee that's charged. So and actually what's available will be directly related to how much you have saved and how much you contribute. So people's expectations need to be aligned with reality. And then this is also really great news. When we ask them, where will you turn for advice? 52%, so half of that 12,000 people said, I will ask my financial advisor. So you should all be getting lots of requests for meetings and appointments because people don't understand and they need advice and they say they want to talk to you. And then some of the essential things that I thought would be useful to lift, and we can get into it, is most providers are looking to do a highly digitally enabled process, simply to allow for the volumes we expect and to keep costs down. So some of the things you can do in advance to get your customers ready is ensure they've got all their contact details, totally up to date. Simple things like name, surname, ID number, tax numbers. So in the past, that would only become relevant when you're changing jobs, when you're leaving, when you're retiring. But now on an annual basis, if a customer has an emergency and wants to do a withdrawal, the more information that's available, the more seamless that process can be. Maybe the first point also, if you've got customers in various funds, check that those funds have actually registered their rule changes. So the FSCA has given the 15th of July as the due date for when funds have to register their rule changes. So to enable the funds compliance with this new legislation, funds have to go and update their rules. And I think, if there's still about 1,500 funds in the industry, the FSCA is going to have a very busy July, August to get through all those rule changes before 1 September. And then get your customers to also check whether they're even eligible. So as Tandazile mentioned, the minimum withdrawal is 2,000 Rand. So someone who's just started or just joined a retirement fund, they might not actually even be eligible for a first withdrawal. And then that they understand that there's a tax impact and a withdrawal charge, most likely a withdrawal charge. So almost no one's actually going to get 30,000 Rand out. And then assist customers to decide. And I think that's really where the biggest value financial intermediaries and planners can provide. So as Old Mutual, of course, we will be technically ready. We've registered, or we're in the process of registering our rule changes for most of the funds we either sponsor or administer. But we're also focusing quite heavily on information, education. You're welcome to go to our website, and we've put up a couple of videos. They're on YouTube. They can be downloaded. So simple explanations that can be shared widely with people. And it's available in 5 different languages, just for people. And I think the more information people get, the more likely it is that the message will land about what this thing is and what does it mean for you. And that's all I wanted to share, Zahir. I know you keen. You used words like pot and stir. So you do want us to get into some robust conversation as well. But thanks so much.
Absolutely. Thank you so much, Prabhashini, for a really interesting presentation. And so I just want to, for me, some interesting points are the study or the customer insights that we're looking at, how members spend their money. So I'm quite interested in the 1% that said they're going to use the money to pay for their children's weddings. Like that's an interesting point right there, Prabhashini. And then also interesting was the 1% of your customers that will look to social media for advice. And I think that really speaks to how the industry's changed over time, and how we need to adapt to that change. Although it might not seem very significant at 1%, I imagine that percentage will only grow over time. So again, thank you so much, Prabhashini. Yes, you are absolutely correct. I'm really keen to start the panel discussion. I do think we can address a lot of the unanswered questions there. And so I'd like to introduce some of our other panelists. And so joining Pravashni and joining Tandazili, we have Johan Prinsloo from Sanlam, and we've got Dwayne Nike from Alex Forbes. And just for some background, Johan Prinsloo is a seasoned business manager with over 23 years of experience in the retirement fund industry. And I think that experience will do you well in this discussion. Johan, some of Johan's key achievements within Sanlam are rehabilitating the retirement fund administration income streams and project sponsoring T-Day. And then I think more relevant to today's discussion, Johan is also currently the project sponsor for the two-pot system. And then we've got Dwayne Nike, who is from Alexander Forbes. He's the head of retirement solutions. And Dwayne's mandate includes spearheading growth initiatives for Alex Forbes umbrella retirement funds, institutional investment products, and platform capability and health advisory services. Dwayne's role has recently expanded to oversee the intermediated clients business unit. So again, very relevant to our discussion today, with the firm focus of improving independent intermediary partnerships. So welcome, Johan and Dwayne. Before we begin, I would like to invite both of you to make a quick opening statement or remark. Johan, let's go to you, Johan, and then we can move over to Dwayne. Johan, you're muted.
That's never happened to me before. Thank you for the kind introduction, and I see it's now officially good afternoon to everyone. So I was asked just to do a 2-minute quick feedback. I think the first thing that I became aware as two-pot and the project unfolded is that there needs to be a common understanding that your administrator or RA or umbrella provider cannot implement two-pot successfully on their own. It's going to take the cooperation of all stakeholders and role players in the industry to make two-pot a success. So that includes our benefit counsellors, our employers, our members, our participating employers, and also our financial advisors. And that's also included the benefit consultants, because we see that from the stats that Prabashini showed is that not a lot of members is confident about what two-pot means, and that change management is a massive task. And if we don't take hands to pull that off together, it is going to be a bit of a struggle. Thanks, Zahir.
Absolutely. Thank you so much, Johan. And I agree. Dwayne, over to you. Please share your opening remarks with us.
So thank you very much. And firstly, well done to our presenters today. Exceptional content, exceptionally well delivered. And welcome to the members, and I hope you're enjoying the session. I'd like to echo Johan's sentiments. I think, it's fortuitous that we're just gone through an election process, and the hype at the moment is this government of national unity. And it's no different to what's been occurring in the retirement fund sector in the last year. Not even the last year, I think Alvina mentioned over the last 12 years, if not longer. It's the culmination of thinking and the evolution of thoughts and processes and input from industry stakeholders, the regulator, the retirement fund product providers, consultants, members, employers. It does take a complete village to get this off the ground. And I think that's an important sort of mark for the retirement fund sector, is just this collaboration that we're seeing that's quite tangible, that needs to continue into the future. I think the second point that it's becoming quite evident is the shift from institutional to retail. So the introduction of 2-point essentially brings in a retail component or transactional component into the retirement fund sector, which never really existed before. And we've got to adapt as product providers, as advisors, as employers and members to deal with the new issues that are going to come through as a result of that. So 2 of those concerns or points I'd like to make there, Zaire.
Thank you so much, Dwayne. And absolutely, I think the analogy is an excellent one, Dwayne. You know, I think there's a certain amount of unity that's required for the successful implementation of the system. And so thank you both for those comments. So okay, so I'm gonna jump straight to our questions. I see they're coming in hard and fast. And so yeah, so for the anonymous users, I'll share the questions. And for those users that were brave enough to share their details, I'll ask Delani to activate your camera and your mic so that you can engage with whichever of the panelists you'd like to. Tulani, can I ask you to please bring Henry Dill into the conversation? I see he posted a question 27 minutes ago, and I'd like him to direct that question to our panel. And I see, so Henry, if I look at Henry's comments, Henry's got some strong feelings around the implementation of the two-part system. Welcome, Henry. Welcome.
Thank you, Say. Thank you, everybody, for your contribution. I think it's helpful. I think Prabhashni made the comment that two-pot is the biggest thing that's happened in the last 20 years in the system. I'm going to go back. I'm nearly 40 years in the system, and to me, it's the biggest thing that's happened over the last 40 years, affecting us directly. I mean, there's big things that happened, DC, DB, etc. But two-pot certainly is a major issue that creates a lot of issues for us. My concern is a couple of things, and I think all of you raised the issue. Okay, so let me get back to the first question. That's what I was. It is Tabashini. What is sorry?
Prabhashni.
No, Tabasile. Tabasile.
Oh,
My question was.
yes.
Yeah, was initially aimed at you. So if I may ask you, I'm concerned that government issues many discussion papers to people or in the industry. For me, as a small player in the industry, it's extremely difficult to participate in these discussion papers. I mean, I basically work for myself. I work on an hourly rate, and to spend 10, 50 hours analyzing a discussion paper, commenting on a discussion paper, is very difficult. For the big players, it's easy. They've got people employed in the legal departments. They analyze and they look at all these proposals that come out, and they comment and often valuable comment, but often it's tainted to suit their own needs because they've certainly got vested interest in where the market goes. Isn't there a way that government can work on a basis where you can actually get experts in and give independent advice or independent assistance to government on what is happening in the industry?
Thanks, Henry. Yes, Tantazile.
Can I go? Oh, okay, great. Thanks. Henry, thanks for your question. I think Johan has answered it for me, that this is more or less a collaborative effort. I agree that not everyone is able to even see the discussion papers that we issue for public engagement. But if we all work together, for example, we issue the discussion paper, and industry or the relevant intermediaries are aware of this, they should be able to communicate with the members, that is the clients, the customers, because that is largely followed by a law or a draft law that also goes for public engagement. That it's another opportunity for industry, regulators, everyone that sees this, to ensure that all relevant stakeholders are made aware of the changes. Following that, the bill goes to Parliament. Parliament again calls for a consultation process. So I understand as individuals or fund members, we are quite passive when it comes to retirement contributions. We do not get actively involved until one is left with less than 5 years to retire. Then it's like, oh, how much do I have? And then they are not even aware of the changes that have been happening. It becomes a bit late. Hopefully, with the two-pot system, as Prabhashni mentioned, because there will be that active involvement between the fund, the member, the advisors. A member will be more aware of what is happening and sort of take that initiative to keep abreast of the information and the developments, not just with respect to the two-pot system, but everything else, hopefully, whether it's their investments, their savings. I can only hope that the two-pot system does spark some level of activity or activeness on the side of the member. Thank you.
Well said, Desiree. Thank you so much for that. Hindi, yes, you've got a counterpoint, Hindi. Please share with us. Hindi, just one moment. Your mic is muted.
Apologies
There
for
you go.
that. Now I'll leave that subject there. I think it's a debate that we can go through. I've got a couple of other questions that I would like to ask the other panelists. The going on a digital platform, I understand that. I mean, you're going to have, for the 1st of September, you're probably going to have hundreds of thousands of claims. Will that digital platform be rolled out to other benefits? So if a member then reaches retirement age, will he be able to claim a retirement benefit or any withdrawal benefit at that stage? And doesn't that lead to disenfranchising the financial advisor? Because now the member deals directly with the provider and cuts out the financial advisor. And how does this address the regulations with regard to counseling services? How can we now make sure that people actually get counseled? Thanks.
Thank you so much, Hindi. I think, you know what, Hindi, your question is actually well suited to all to three of our corporate panelists. And so I'll invite each of you to maybe just comment briefly on what Hindi is saying. And I think the crux of what you're saying, Hindi, is that there's the potential for disintermediation through quite a digital process, you know, sort of as we approach implementation. And so, you know, so what are some of your thoughts around that? And what are some of the measures and processes that your respective organizations are putting in place to prevent that or to address that? And so if we can start with you, Prabhashni, and then we can move on to our next panelist.
Thanks so much, Zaire. I think we can't ignore technology changes in digital, but we have to figure out how our role changes. I'm saying our, I mean us as a financial services industry, including intermediaries and planners. I don't think customers, because they're saying to us, you know, they've got the information, they have all these apps, they have all the stuff, but they don't necessarily understand it. And some of them still haven't decided. So I think there's a big challenge for us as an industry then to say, how do we provide what we provide in a way that, you know, uses and leverages digital? I don't have the easy answer, Henry, but I think it's something we're going to have to think about. So how do we interface with the member in the right way? So even though the transaction is digitally enabled, we still give the right counseling, the right advice. So then they you know, click the right button, so the right transaction happens. And I think we have to be looking at how do we integrate technology into our practices? And it's unavoidable, unfortunately. I don't have the answer yet about other transactions, but I think absolutely, if it works for this, and your members and your customers become comfortable with it. The other thing we're spending a lot of money on is on the security around it. So it's easy to say go digital, but then you got to think about how can this be intercepted? How can you be sure you're dealing with the person who, is trying to withdraw? So I think there will always be a need for the human advice, but we're going to have to really think. And you say this is the largest change in 40 years. I think the technology changes is maybe even bigger than the regulatory change. And that's how we're trying to see it. We've got to embrace it. We can't avoid it, but it's going to require some reinvention. Yeah.
Yeah.
Absolutely. Johan, please. I
So-
see you nodding along.
Yeah, because it's exactly the same challenges in the Sanlam stable. Henry, I think, however, from a disintermediation perspective, I think actually the opposite is going to happen. And I think for us as service providers, we want to make it easier for the intermediary and the member to act with us. But if you looked at the complexity that Two-Pot is going to bring into the system, especially at resignation and at retirement, currently a member only has to make one choice in terms of when they resign, for example. It's the vested pot, as it would be called in the future, and it's the same tax dispensation. After Two-Pot comes in, they're going to have to make three choices because it's different tax rules that apply to each pot. So, for example, we heard from the savings pot, if you resign within the same tax year that you made a withdrawal, you cannot withdraw unless it's below 2,000. At retirement, there's particular rules that apply. The tax dispensation is different for each type of withdrawal. So I see the role of the financial advisor increasing exponentially as opposed to a case of disintermediation. I don't think that's the intention of the technology. The intention of the technology is to make it easier for stakeholders to interact with service providers, especially if you look at AI and AI-led type of inquiries. And then the second point, or the second question relating to benefit counsellors, we also picked up that your benefit counsellor is going to play a crucial role given these complexities that's coming into play. I think the difference is your benefit counsellor can give factual advice or factual information, sorry. I think I'm going to get a fire penalty. Factual information to members where your financial advisor can actually give financial advice. And there's a big difference between the two, because I think the other area where it's going to be very relevant is the reasons for a withdrawal from the savings pot. Like Pravashini pointed out, is members now call in and say, I want to settle, consolidate my debt, I want to pay for my child's education, all those sorts of scenarios. Benefit counsellors cannot give a yes or no answer to those kind of questions. They can only explain the consequences of a cash withdrawal from the savings pot to a member, which is losing out on interest and not enough money to save for retirement. However, I think the role of the financial advisor is different in the sense that they can go into the financial acumen, the financial environment of a particular member in order to make an informed decision, because I do think we're going to see borderline cases as to reasons for withdrawal from the savings pot, and simply because an emergency is a different experience for each individual. Thanks.
Thank you so much, Johan. Dwayne, please share your thoughts with us as well.
Thanks, Zahir. I think we're dealing with a lot of passionate people here, so you're getting some really good feedback. And Henry, I hope you appreciate some of these comments. I think the first thing is just to go back a couple of years and realize that the two-pot system is not the legislation that is creating this intermediation in a sense. A couple of years ago, the legislation was changed to allow individuals to resign from employment and retire from employment without necessarily withdrawing their retirement savings or retiring from the fund. So those were two distinct applications in a sense, which could be initiated by the member to some degree once the employer had acknowledged that there's been an exit event. It is a tough one to try and understand how technology has affected the system. I think what you're going to see is, and I think Johan alluded to the fact that AI is everywhere. Our lives have changed fundamentally in the last year to year and a half. So you're going to be hearing from a technology perspective, especially in the employee benefits landscape, acronyms such as OCR, KBA, STR, which is your optical character recognition, knowledge-based assessment, straight through processing. All of these things are evolving the way in which we process claims. Two-pot is a member-initiated claim, so we've got to appreciate that it's not going to flow through through an employer. It's not necessarily going to flow through an advisor unless there's specific frameworks that are put in place. But you're balancing a need for a member to access those retirement savings versus trying to get the best out of the solution for the member. So it's a very difficult one. And as Johan and Prabashni mentioned, I think it's how the technology evolves. Members have access to information, but what can we do as product providers to amend the counseling frameworks and the advice frameworks to ensure that members are redirected to advice when they need it the most? Linked to this, one of the scary things is some of the research we've done is that the debt to income ratios across about 900,000 individuals is sitting at about 77%. And that's a secured and unsecured debt. More than ever, we need financial advisors to actually consult their clients to understand that the two-pot could very well improve their financial outcomes, not just because of the retirement component, but potentially utilizing that savings component to offset unsecured debt and reconfigure their saving strategy for the future. So, yeah, Henry, it's a tough one, but I do think that you will see the maturation of advice frameworks and counseling frameworks in the near future to adapt to the landscape that we're in now.
Thank you so much, Dwayne. And excellent points from our three corporate panelists. I think it's a little bit uncertain for most of us in this industry. And I think a lot of our processes and a lot of our traditional ways of doing things are going to change. And of course, that can be scary, but it does also present an opportunity for financial advisors, for intermediaries to sort of refine their value proposition and find ways to insert themselves into the conversation in the best interest of the members. And so thank you so much for that, guys. Okay, lots of questions for our panelists. Let's see if we can get through all of them. There was a question, I think this one I'll direct to Tandazile. And it's a question around divorce orders. And so Floyd Kumalo was the person who posed the question. And it's quite a simple and complicated one at the same time, Tandazile. But Floyd said that he's still unclear on divorce orders and Section 37D deductions, which part, why, and how. So if you want to just comment on that, Tandazile, that would be great.
Fortunately, Floyd's question is not that clear, but divorce orders post implementation of the two-pot system will be allocated in terms of the three pots. So there has to be a divorce order, and that divorce order, whatever percentage, will be proportionally taken from the members' three pots. So if a member has a savings, retirement, and vested component, the divorce order settlement will be taken or deducted from those three components to pay to the non-member spouse. I think that's unless if he's able to unmute and clarify further the question if it's not properly covered. Thanks.
Thank you so much, Tandazile. I think, let's move on to the next question. Floyd, if you do want to clarify anything, you can just drop us a message and we'll see if we can go back to that. There are some questions, and I'm seeing quite a few of them that speak to the advice fee or the withdrawal fee. And I think, Prabashini, you alluded to that fee in your presentation. And so I'm just trying to find the question and also who posed the question, but it was posed specifically to you, Johan, and to you, Dwayne. And so I just want to chat through it with you quickly. Um, I'll give you the gist of it. So some of the questions are around what will Sanlam and Alex Forbes charge as a transaction fee for processing withdrawals, and it's been worded differently across some other questions. I don't suspect that you'll have all of the answers right now, but what are the discussions Sanlam are having, and what are the discussions Alex Forbes are having around that withdrawal fee? And then, Tulani, I'm going to ask you to put on Johan Olafier's camera as well, because his question also touches on that. And so then Johan can also clarify on his side. So over to you, Johan and Dwayne.
Right. So from a Sanlam perspective, we also plan to charge a fee for a withdrawal from the savings pot. That fee is still under discussion internally, and we'll go to market shortly. What I can share is, I think, around the principles, what determines that fee, because um, as mentioned previously, this is now a brand new service. And what does that service look like? And I do expect that service providers, for different reasons, will probably in the beginning charge a different fee, but that will probably align over time. So the principles of this, and this is to the point earlier, and why I agreed so vehemently, is we are still businesses that need to implement DUPAT in our environment. There is an administration cost attached to it, and you have to charge a fee in order to recover some of those capital expenses, but also the ongoing administration fees cost. Okay, so that's the first principle. The second principle is that you have to design a fee that is probably commensurate with the minimum withdrawal. I mean, if you're going to charge a big fee, bearing in mind the 2,000 Rand minimum withdrawal, that can't be disproportionate. I think the third principle is also to say, but listen, to a certain extent, should this fee not have a bit of a sting in it in order to prevent frivolous withdrawal from the savings pot? Because we all know that it needs to be applied in case of an emergency. So the question is, whether that fee should represent that kind of a sting to deter members to unnecessarily withdraw from the savings pot. And then I think the fourth thing is, if you look more towards your retail industry, especially your RA environment, then we know there are certain fees, maximum fees prescribed. And from a legislative perspective, if there's a maximum fee, does it then make sense to borrow from that legislatively prescribed maximum fee in order to determine or use it as a benchmark for determination of this fee for the cash withdrawal from the savings pot? So we're having the same debates as Old Mutual, and it's balancing all those factors in order to come up with a fee that makes sense.
Thank you so much, Ron. Dwayne, I think jumping here, be an outlier. Say Alex Forbes is charging this rand amount per month. No, I'm joking, Dwayne. Please.
As I hear, not yet there, but I think the principles Johan mentioned are absolutely valid. You've got to be fair in the process, and I think it goes back to understanding that the regulation talked about the charging of a fee, of a transaction fee, but it's not regulated. So it's not confirmed in terms of what the maximums or what the minimums are, which does provide a bit of a touchy point for the industry, because what Prabashni and her team are going to be doing, what Johan and his team are going to be doing, might be very different to what Alex Forbes and the team will be doing. And some providers not potentially charging it all. So there's quite a myriad of perspectives in the industry at this point in time. One thing that is driving this is again the investment in infrastructure is been significant. It's across digital platforms, it's across administration systems, it's upskilling administrators, it's upskilling all personnel within the business to be able to deal with this. And also, if you just think about the withdrawal claims itself, you move from a touch point with an individual who is essentially getting paid, or used to be paid out a single claim over their membership, to now an annual claim. And that sort of workload needs to be really factored into how do you actually apply this to the business environment. So we're trying to be fair, and you're right. There's no one answer that meets the ideal situation or requirements here, but we will be communicating soon as well. And I think the industry is eagerly awaiting the announcements from all of the providers in terms of what these fees are going to be. I think there's a bit of anxiety in the system because of that. I think it's important just to understand that there is actually an important need to charge this fee. It's not just to try and profit over transactions, but it is ultimately to recover costs that have been sunk into the system.
Thank you so much, Dwayne, for that response. Okay, so lots of questions and not much time left, so I'm going to try to wrap things up. But just for our audience, just for your peace of mind, I'll just reiterate that we will do a communication post-webinar that addresses those unanswered questions and also provide some links to some of the content that was shared today. Tandazile, so I need to just choose these last one or two questions very carefully. Tandazile, there's an interesting question that I'm picking up, and it speaks to the fact that participation in a retirement fund is not currently compulsory for all employers. Or it's not compulsory for employers to provide retirement fund benefits to the employees. There's been a lot of talk, Tandazile, from the Minister of Finance. I think it was if I remember correctly, I think in 2023, he mentioned that National Treasury were busy finalizing some policy proposals on how to expand participation. And it I think is an interesting question. It speaks to that auto-enrollment, Tandazile, and if you could share sort of where we are on that, is it something that's been pushed to the back burner for now? Is it something that's still very much on the radar for National Treasury? Can you share your thoughts on that, please?
Thanks, Sahir. So that proposal to extend coverage to all formerly employed individuals into the retirement system is still on the table. Government has, through Department of Social Development, issued a discussion paper. It was issued, I think, in 2021. It was then withdrawn. Comprehensive Social Security Reform. They've issued that green paper again for public engagement. So that paper proposes auto-enrollment and mandatory enrollment for all that are employed. So the proposal is still on the table. Thanks.
Thank you so much for that, Tandazile. And then to the rest of our panelists. Okay, so I'm going to pose this question, but I'm going to pose it to all three of you. It's an interesting one. It might be a little bit tongue-in-cheek, but answer as best you can, and you can use this as an opportunity to make any closing remarks that you might want to make. So we had an anonymous user. I'm really sad about that. I really wish this user would have included their name. But the question is, who is responsible for explaining the new system to the millions of members in employee benefit schemes? And so that's the last question that unfortunately we have time to address. But now we'll take answers from our three corporate panelists. Prabashni, let's start with you.
Yeah, I think it's a great question, and I think all of us are. That's my personal view. I think we have a responsibility as Old Mutual, as both a product provider and an administrator. I think the financial intermediaries, the intermediary industry, that goes to the heart of what you do to help people navigate, and the financial world, unfortunately, is still quite complex. And that's unfortunate and that's fortunate because part of what we do is help people navigate that complexity. So that's my view. We both have a responsibility. I think National Treasury, FSCA also has a responsibility. So it's all of us in my view. Thanks.
Absolutely. Thank you, Prabashni. Dwayne, let's jump over to you. What are your thoughts on that?
Echo that. I think it was part of the opening sentiments as well, is that it's an industry of national unity. In a sense, we all have to pull the line here, and we must also we've got to bridge the gap. I think generally members are quite apathetic. And speaking for myself, sometimes you wait for the last moment to do things, and we need to be more proactive as individuals. So encouraging your friends and family to take a better interest and a bigger interest in their finances is quite an important thing that we should all be encouraging. But more broadly than this, it's the regulator, and Alvina's presentation was fantastic, and they've put out a lot of content on their website. The product providers have done so. These sessions help improve intermediary understanding around some of the technical issues, and from the questions you can see how important these sessions are. So it's just a multitude of different stakeholders that actually need to come together to deliver the message to members.
Couldn't agree more, Dwayne. Johan, your answer and any closing statement?
I couldn't agree more with other panelists. I think the approach we've adopted is to pay it forward. Knowledge about two-pot is a very specific set of information, and if you can pay it forward to the next person, to your participating employer, to your benefit counselor, to your benefit consultant, to your financial advisor, they in turn acquires the ability to educate their stakeholders on two-pot. And that's really the only way I can see how we can move forward from a knowledge perspective in educating members around the intricacies of two-pot. It is really a case of all of us together are responsible.
Thank you so
Thanks.
much, Johan. Johan, Prabashni, Tandazile, Dwayne, I think if our government of national unity can come together the way that the four of you seem to have come together, I saw a lot of agreement on so many of the points, then I think we've got a successful future ahead of us. But more seriously, thank you so much for your participation in today's event. Your views, your insights are incredibly valuable, and judging by the questions, you've incited a lot of interest and a lot of questions. And so we'll absolutely be reaching out to all of you to help us address all of these unanswered questions. But yeah, I think we've got an exciting 73 days ahead of us. Tandazila, I imagine you'll be exceptionally busy, and the same is true for our three corporate panelists. So I wish you all the best of luck. And then, of course, to our audience, to our intermediaries, I'll just end off by saying that I think, sort of based on what our speakers have said and based on what's come through in the panel discussion, I think it's incredibly clear that we've got a great opportunity, an incredible opportunity to sort of redefine retirement planning. And I don't mean to speak too ideologically, but create a future where every South African can look forward to a dignified and secure retirement. So I know that's a big statement, it's a bold statement, but my belief is that the two-pot system is sort of is taking us towards that space. So again, thank you all for your insights and your commitment. Thank you for joining us on this webinar. And we look forward to engaging more with our members. And we look forward to pulling in our speakers and panelists again for further discussions, because this won't be the last we've all heard of two-pot. So thank you, everybody. That concludes the FIA 2024 Employee Benefits webinar.